Kamal had come a long way in 7 years. He still remembered that first demo trade, shaky fingers, wide eyes, and the $500 demo account that felt as real as cash. When he finally went live with $1,000, every $20 loss felt like a gut punch. At this stage, it wasn't just money, it was rent, pride, and survival. But tonight was different. He is now managing a $250,000 funded prop account. And the trade in front of him, he was risking $1,000 to make $3,000. Same setup, same strategy. But now, it barely raised his pulse. He paused, not out of fear, but curiosity. Why didn't this feel like it used to? Then he remembered a line from a book, quoting Swiss mathematician and physicist Daniel Bernoulli. The value of money is not absolute. It depends on the person and how much they already have. Bernoulli wasn't talking feelings. He was talking math, utility. The idea that the value of $1,000 isn't fixed. It bends and warps depending on how much you already have. For Kamal, risking $100. Back when he only had $1,000 was risking everything, and that $100 wasn't just capital. It was stress, fear, and hope. Now, risking $1,000 was less than 0.5% of his total account. It is practically a blip. But here's where it gets interesting. Most traders believe that if they just had more money, they'd finally be calm, fearless, and confident. But they're missing the point. Confidence doesn't come from a bigger account. It comes from proper risk management. Kamal didn't become calm because he had more money. He became calm because he learned how to manage risk. This is utility theory in action. The true meaning of risk management. Let me tell you a story, not from Wall Street, but from Shakespeare. In The Merchant of Venice, Antonio makes a bold move. He borrowed money from Shylock, a cold-blooded lender, not for himself, but to help a friend. The catch: no gold, no property as collateral. Instead, he offers something far more dangerous, a pound of his own flesh. If he can't repay, Shylock gets to carve it straight from his body. Antonio is confident his ships are out at sea, full of goods, and he believed they will return with riches. But they didn't, and the ships were lost. And just like that, Antonio learns the hard truth. It is never about how big the debt is. It is about what's on the line. And this is where most of us traders get it wrong. We think risk management is all numbers. I only risk 2% per trade. My risk to reward is solid. It's just $500. No big deal. But utility theory and Antonio's mistake whisper something deeper. It is not about the percentage. It's about what that risk means to you if it's gone. To Antonio, that pound of flesh wasn't just flesh, it was his life. When you risked too much, too early, every trade feels like life or death. But when you size your positions right, everything slows down. Your mind clears, your edge sharpens, and you stop trading emotionally. You don't need a massive account to trade like a pro. You need to manage risk like one. Because risk management isn't just a safety net. It's the foundation for calm, control, and long-term growth. It is what separates traders who spin in circles from those who build real lasting wealth. In this video, I will show you exactly how the successful traders properly manage their risk, not just to protect their capital, but to multiply it and become millionaires in the long run, and how you can do the same. The Schrödinger's trade approach, the mental side of risk management. Imagine this. Every time you enter a trade, you're placing it inside a box. And inside that box, the trade is both a winner and a loser. At the same time, you don't know which one it is. Not yet. And you won't, not until it closes. That's the mindset. That's the Schrödinger's trade idea. This approach asks you to do something radically different. Treat every open position as both a winner and a loser at the same time, thus staying emotionally neutral until the trade is actually resolved. The Schrödinger's trade approach is inspired by the famous Schrödinger's cat-thought experiment in quantum physics. In the experiment, a cat is placed inside a sealed box with a mechanism that has a 50-50 chance of killing it. And until someone opens the box, the cat is considered both alive and dead at the same time. It's a metaphor for uncertainty, the idea that two opposite outcomes can exist simultaneously until observed. When applied to trading, this mindset suggests that every open position is both a winner and a loser at the same time, until it closes. Why does this work? Because it detaches you from the noise. It stops the emotional roller coaster that wrecks your decision-making. It helps you stick to your plan, manage your risk, and let your edge play out without constantly trying to peek inside the box. And the beauty is, this mindset doesn't just apply to trading. Our life, too, can exist in a kind of Schrödinger state, where success and failure are both real possibilities in the early stages. We might be growing, but they are things shrinking. Momentum might be high, but cash flow is tight. You're both winning and losing until the long-term result unfolds. So if you're managing a trade, running a business, or just going through life, the core idea holds. Stay present, stay neutral, and respect the process. Because the moment you assume the outcome, you risk ruining it. The top 5% risk management rules. These rules won't guarantee strikes, and they definitely won't make you rich overnight, but they will keep you out of the gutter, and in trading, that's half the game. Because this isn't just about saving your account, it's about saving your headspace, your confidence, and your ability to come back tomorrow and take the next shot. The truth is, anyone can crush it on a good day, but the traders who last are the ones who take hits, stay cool, and keep executing, even when the market punches back. That's what real risk management gives you. Not hype, not hope, but the one edge that actually compounds over time. And that is how you make a fortune in this business. Let's break down exactly how to do it. 1. The risk-it-all deposit rule. I know it's easy to say just manage your emotions when trading, but let's be real. It's a whole different story when your actual money is on the line. So what if instead of relying on willpower, you had a built-in model that made emotional control automatic? Here's one simple hack I have used in the past that I think might work for you. Only deposit the exact amount you're willing to trade with into your brokerage account. That's it. No more, no less. Why? Because when you limit what is at stake, you limit the emotional chaos. Suddenly, you're not staring at your life savings every time a candle pulls back. And if your setups are clean and your process is sharp, you don't even need a stop loss. Just set your take profit and walk away. Your entire account is your stop. It's like emotional risk management on autopilot. But here's the warning, and please, don't ignore this. If you don't know how to trade, if you haven't put in the reps, the study, the testing, you will definitely get wiped out eventually. No model saves you from bad entries and weak plans. This isn't a hack to skip the work. It's a system to protect your psychology while you sharpen your edge. Use it wisely. 2. The 1% rule. The core survival mode. Never risk more than 1% of your trading capital on a single trade. Have $10,000. That's $100 max. Got $2,000. You're risking $20, not a penny more. This isn't playing scared, it's playing smart. Because even if you hit a brutal 10-loss streak, you're only down 10%. That hurts, but you're still breathing, still thinking, still in the game. And being in the game is everything. Which brings us to 3. The 0.5% rule. The prop firm risk management. When it's not your money on the line, the margin for error shrinks. If you're trading a prop firm account, tighten it up. Risk 0.5% per trade. Some people go down to 0.25%, and I am one of them. Because prop firms have strict daily and total drawdown limits, and one oversized trade can get you disqualified instantly. No warning, no appeal. You don't get to recover, you're just out. So trade like a sniper, clean, calculated, and precise. And if the day starts going south. 4. The 2x daily loss limit. The art of walking before you bleed. If you hit 2% in losses in a single day, stop. Full stop. Shut it down. Not later, not after just one more setup. Because after a loss, you're not the same trader, your logic's off, your emotions are louder, and your biggest enemy, you, starts driving the bus. That 2% loss is manageable, but if you keep pushing, it quickly becomes 5%, 6%, 8%. And now you're in a hole that takes weeks to dig out of. You need to protect your mental capital like it's gold. And while we're at it. 5. Never adjust risk mid-trade. Set your risk before you click buy. Not after, not when the market feels different. Don't move your stop. Don't double down mid-trade. And please don't convince yourself that this one's about to go. Set the risk, lock it in, and walk away. Which ties into this. 6. Only risk on high probability setups. If it's not part of your system, it shouldn't get your money. No boredom trades, no gut feelings. No, let's see what happens. If you wouldn't take that setup 10 times in a row, skip it. Consistency is built on repetition, not randomness. And finally, 7. Cap weekly losses to protect your sanity. 3 red days in a week, down 6% total. You're done for the week. It is time to step away. Not forever, just long enough to reset. Review, reflect, and regain your edge, because revenge trading your way into the weekend is a fast track to regret. Stack these rules together, and what you've built isn't just a system, it's a fortress. This is how real traders play the game. They don't just chase profits, they protect their edge. They treat risk management like it's sacred. That's how you stay consistent. That's how you scale. And that's how you win. Not once, but over and over again. After years of holding back, I'm finally opening a few one-on-one spots where I'll personally walk you through exactly how I trade, step by step. Spots are limited, but if you want in, fill out the form in the pinned comment to join the waitlist before it closes. If you want to know why risk management isn't just important, but the only lifeline keeping you in the game, you need to watch this recommended video. It will change the way you trade forever. If this video hit home, please drop a like, share it with someone who needs it, and leave a comment below. I read and reply everyone. Until next time, trade smart, stay sharp, and may the trend be with you.